In this video, I covered the best dividend ETFs for 2025 to provide consistent income and long-term growth. What's happening in the market? With the recent Bank of Canada 50 basis points interest rate cut, unfortunately, the time to get 5% from GICs has passed. And consequently, high interest savings accounts have gone back to their barely existent 2% interest. So your money is losing value every day with inflation and currency devaluation. So what do? Please don't make the mistake that I made of sitting on it and saying, I'll figure this out later. And a year passes and you've done nothing about that cash sitting in your bank account. Leaving $10,000 of cash in your bank account will lose about $300 of value in 12 months' time and be worth $9,700, assuming a 3% long-term average inflation rate. So for 2025, be intentional and put your money to work for you by turning to the stock market. And that's why this video is here to help you do just that. I've done hours of research and diligence for you and put my best dividend ETF picks for 2025. Let's get started. Given my low risk appetite, my investment strategy is focused on dividend ETFs. Two reasons for that. Dividend ETFs provide stable income and diversification. To understand how to analyze and compare ETFs, you need to know some basics. So what is an ETF? An ETF is a collection of stocks. By owning an ETF, you own stocks of different companies. The benefit of an ETF is diversification, so you're less exposed to holding the stock of a single company. However, this diversification for managing the basket of stocks doesn't come for free. So you have something called a management expense ratio, or an MER. The MER is what you are charged by the fund manager for managing the ETF. You will not find any MER in individual stocks. So this is an aspect to remember when considering ETFs. So if you have 0.05% MER listed on an ETF, it means that for every $100 that you invest in, you are charged 5 cents in management fee. It's important to note that this amount is deducted every year. So in a year, if your ETF made losses, that MER would still be deducted. So think of it as a fixed expense like rent that you have to pay every year, regardless of whether you've made a profit or not. ETFs are still very low cost in their management fee compared to mutual funds that have significantly higher fee. Another critical aspect to understand when comparing ETFs is dividend yield. Dividend yield is the income that the ETF pays to you every month or quarter. To compare ETFs, you need to be able to compare dividend yields. I focus on the trailing 12-month or TTM dividend yield since it's based on 12 months worth of historical dividends paid versus the SEC yield, which is based on the most recent 30 days of dividends paid and is less reliable for predicting future dividends. To compare dividend yields between ETFs, you should compare the net yield, which is the TTM dividend yield minus the MER to get an actual representation of the income you will get in your pocket after buying the ETF. So let's start off with my first top pick, which is the US ETF SPYD. SPYD tracks the S&P 500 High Dividend Index, which consists of 80 high dividend yielding companies within the S&P 500. The S&P 500 index is 500 of the largest US companies. The ETF holds 83 companies equally weighted, so is well diversified, providing exposure to large cap US companies with a focus on high dividends. The sector exposure is 24% real estate, 18% financials, and 18% utilities. Holdings include Pfizer, Kraft Heinz, General Mills, and Walgreens. SPYD focuses on high dividend yielding companies, which typically excludes major tech companies like Apple and Tesla that reinvest profits towards growth rather than paying high dividends. The TTM dividend yield is 4.28%, paid every quarter. The MER is 0.07%, so it's low cost. The net yield is 4.21%. It's the largest weighted holding in my RRSP. Now, a key point to remember when investing in US dividend stocks is to hold them inside your RRSP. since the RRSP is the only account that is exempt from the 15% US withholding tax on dividends. The other thing to note when investing in US ETFs is that with the Canadian dollar currency devaluation, buying US dollars has become a lot more expensive. It's something to factor in. If you do wish to proceed with converting Canadian dollars to USD, please use the Norbert-Gambit's technique to ensure you're not paying 2% in conversion fee. The next ETF on my list is SCHD. SCHD aims to track the Dow Jones US Dividend 100 Index that selects 100 high-quality, large-cap US companies with a proven history of consistent dividend payments. To be included in this index, a company must have a history of consistently paying dividends, which makes it different from SPYD in terms of its focus on a more sustainable dividend. It has 103 holdings, so it's well diversified. It has names like Pfizer, Coca-Cola, Pepsi. Sector exposure is 18% financials, 16% healthcare, 14% consumer staples, and 13% industrials. TTM dividend yield is 3.62% paid quarterly. MER is 0.06%. Net yield is 3.56%. The next one up is ZCN. ZCN aims to replicate the S&P TSX Composite Index, providing exposure to a broad range of Canadian companies listed on the Toronto Stock Exchange. Think of this as the Canadian equivalent of the S&P 500 Index. It holds 222 companies, so it's diversified exposure to Canadian equities. It holds RBC, Shopify, TD, Enbridge. Sector exposure is 33% financials, 17% energy, and 13% industrials. TTM dividend yield is 2.77% paid quarterly. MER is 0.06%. Net yield is 2.71%. The Canadian economy is typically not as strong as the US economy, so your returns may be lower than investing in the S&P 500. However, ZCN's focus on dividend-paying sectors like financials and energy often provide higher dividends than the tech-heavy S&P 500. So by default, ZCN is a dividend ETF. XIC and ZCN both track the S&P TSX Composite Index. Given their nearly identical structures, sector exposure, and performance, you can choose either XIC or ZCN based on your preference. Next on my list is XEI. XEI takes 75 high dividend companies from the S&P TSX Composite Index. This focuses on Canadian companies with high dividend yields. It has 75 holdings, so is reasonably diversified. It holds Enbridge, TD, RBC, BMO. Sector exposure is 30% financials, 30% energy, 14% utilities. TTM dividend yield is 5.06% paid monthly. MER is 0.22%, so is moderate. Net yield is 4.84%. Think of this as the Canadian brother of SPYD, focused on high dividend Canadian companies. Now finally, we cover a real estate focused ETF, ZRE. ZRE offers exposure to Canadian real estate investment trusts, or REITs, by replicating the performance of the selective equal weight Canada REIT index that constitutes major REITs listed on the Toronto Stock Exchange. It has 21 holdings roughly equally weighted, providing you with diversified exposure to the Canadian real estate sector. Sector exposure is 42% retail REITs, 27% multifamily residential. You're mostly exposed to retail REITs that generate income. For example, shopping centers, malls, and retail stores. Think of Walmart, Loblaws, Canadian Tire. The TTM dividend yield is 5.24% paid monthly. MER is 0.61%, which is on the high end. Net yield is 4.63%. This provides a high dividend and monthly income with exposure to Canadian real estate. Now, here are my top investing tips that I've learned through years of trial and error. Number 1, keep it simple. Limit your accounts to 5 to 10 ETFs for diversification without overcomplicating things. Investing in too many ETFs can make it hard to track and manage your investments effectively. This is the mistake that I made when first investing. It gets hard to optimize for drips, and in the grand scheme of things, the upside isn't worth it. Pick a few solid ETFs and invest regularly into these. Number 2, have cash available to invest for when the market tanks. It is important to take advantage of quality stocks and buy these at a discount when the market is down. A big pitfall that I would find myself in is that I wouldn't have enough cash in my accounts to make these investments. Keep some of your excess cash in low-risk options like a cashable GIC or a cash ETF like cash. Then use that cash to buy stocks or ETFs at a discount during market downs. Number 3, reserve your RRSP room for US dividend stocks. For US dividend-paying stocks, use your RRSP to avoid the 15% US withholding tax. Number 4, reserve your TFSA room for Canadian dividend stocks. Focus on Canadian dividend stocks within your TFSA to shelter your dividends from taxes and aim to invest enough to qualify for a DRIP. This way your dividends are reinvested and this compounds to provide significant growth. Let me know in the comments down below if you want me to cover the Norbit's Gambit technique on how to convert Canadian dollars to USD cost effectively or my growth ETFs. I hope you found this helpful. Thank you for watching.